everyone. It's Rob Golfi here with REMAX, the Golfi team. We got Conrad Zurini, broker, owner of REMAX Escarpment, REMAX Niagara. Telling you, this guy is so knowledgeable. You guys should be watching him and adding him to any social media. Brian Hogben here, man. He's jumping all over in pools and showing the great stuff he's got. But anyway, Brian Hogben, Mission 35 Mortgages. And we got some good stuff to talk to you about today. We're going to talk about cottage country, what beating that they're getting, and also real estate versus mutual funds and stocks. But starting off with cottages, you know, Ontario cottage market has slowed dramatically, leaving many owners struggling to sell inventory. So what's going on? Like, is it finally catching up? I thought this story was like last year or the year before. What's happening? I think the renewals of interest rates now.
Go ahead. You want to go and I'll weigh in.
So all the mortgage renewals from cottage country craziness are coming up right now, right? So everybody bought cottages in 2020. So now in 2025, 5 years later, the renewal's coming up. So if you got a 5-year fixed, you would have been at 1.95% or 2%. Now you're renewing and you're at, 4.5%, 5%. So I think some people are a little concerned about that and putting it up for sale. That's why. Yeah.
So now they're saying in the Kawarthas and in the other areas except Muskoka, they're taking a bigger beating than Muskoka. What is it? It's just richer people in Muskoka. They can afford to deal with what?
Well, that's the brand, right? Muskoka, Lake Joe, that's the brand, right? So the brand gets hit a little less, and those people are pretty stable. They didn't finance. The other guys that did finance, they kind of went to like tertiary cottage market, secondary cottage markets. The other thing is you got the perfect storm here. Don't forget boom, bust, and echo, right? So you got that boomers that own these cottages. Some of their kids just don't have the money to keep them up, and so you got this two things happening: interest rate increase, and then the amount of people saying, you know what, do we really need this cottage? And I want to downsize. And I think that's what's happening out there. And they're saying, I don't want to do this anymore, and I don't want to go up here anymore. The kids don't come up, and lots of maintenance. So, what he had in Florida, same thing. Interest rates, they went down there, bought, they bought in Florida. The dollar went up. They weren't welcome there anymore, quote unquote. So you had that perfect storm for Canadians to sell their Florida homes. Same thing here. Same exact thing here.
You're absolutely right, because I know somebody that the family inherited the cottage, and the one sibling bought the other sibling out, and because it was paid for, and now they have their own house, their own personal residence, probably have a mortgage, and now they got a mortgage on this cottage, and now they're struggling because they're like the upkeep on this cottage is a lot more what they anticipated.
Oh yeah.
So they're trying to figure out, well, do we sell the cottage and rent our personal residence, or do we or keep the cottage and sell our personal residence, or vice versa? So they're in a dilemma. So I think they're probably going to end up selling the cottage and take the inheritance. But now they kind of screwed themselves, because the value is not what they split it up with their other sibling. So they really
gates.
Oh yeah. So they really took a beating on the sale price on that. So, but
renting out the cottage is becoming more and more popular too, because like typically 1 week in the prime months of summertime for a cottage will cover a month of expenses. So it's kind of like, and there is a market and opportunity, because I think more and more people are going to rent up there. So I think you'll see maybe those people, they can weather the storm, because the interest rate increase, it's going to be, palatable, but you can cover that with a little bit of rent. So if you end up renting out for a few weeks out of the year.
I don't know. Yeah. Like Brian, you have a cottage, right? And like, how often do you use it? Like, I know it's nice to have a cottage. To me, I'm too busy to even take care of a cottage, and I mean, and I'm too busy to even
probably go 2 weeks out of the year, right? Like really 2 weeks out of the year.
That's all you do.
And maybe a weekend. So then, like right now, it's rented. I rent it for the peak weeks because it's the most amount of cash flow. It makes the most sense, right? And 1 week will cover a month of expenses. So if I get it rented for 6-7 months, it's covering 7 months out of the 12 to carry it and pay for it.
So would you buy another one? Would you buy another one?
No.
And Brian, when you go to sell that, you got not only capital gains, and that's obvious, but what about the HST? Because short-term rental, you charge HST. Like
That's right. Yeah.
so it's a bit precarious, right?
I think to buy, like, I think if you're someone who's a real estate investor banking on cottage properties, you might want to pick another alternative. For me, it's more of a legacy play. Like, I want my daughter to go there 10, 15 years from now. Like, it's not something I'm ever going to sell.
Right.
To have it paid for, I'm making memories and trying to have someone else pay for my memories. And I think it's a smart play. Whereas other people, if you're just 100% dumbing down, you're totally right, Conrad. There's probably better investments to make than a cottage. But I think if you can have someone pay for that emotional return that you're going to get as well too, bam, you're winning.
Hey, new book, Mission 65. The cottage, get the cottage paid for, Mission 65.
Yeah, exactly.
But you know what? Like, I honestly, for me, now, question to ask you. Now, if you own a cottage and you're not renting it out, can you get write-offs on that? Like, it's a secondary property. It's not your primary property. Can you write off all the expenses of maintaining it and everything else? Why not? Like, you're paying capital gains on it with the government. Why can't you write it off?
I'm not an accountant, but technically you can only write off expenses that are attributed towards generating income. If you don't have an income producing asset, if it's not a rental property, there's no expenses unless you're self-employed, real estate agent, mortgage broker, something like that, and you're going to use as an office. There might be like a gray area there. But,
so rent it out for 2 weeks out of every year, and then you get your regular write-offs. How's that?
Well, I think it's going to be a portion of it as well too, right? Because the other thing too is that they're not going to allow you to call it 100% rental property if you only rent it out for 2 weeks out of the year, because you have a physical component to it.
Yeah, I gotcha.
But you know what's interesting? There's a great story, and I'll segue a little bit here, but there's a great story in the Globe today about these people that rented it to their own family, and they took a loss. They took a loss for 3 years, and then after, like, when it got to the third year, CRA came a knocking and said, "Hey, if you've got a habitual over 3 year loss, we don't expect you to make any money." They got walloped.
They're watching.
Right? They're watching, and they said you can't claim that loss. That's kind of a fake loss. You know what I mean? So it's interesting. Yeah. You got to look at every corner. They're watching, man. They said if you lose money, and businesses too, if you lose money for 3 years in a row, expect an audit, because if you can't make it profitable, then there's something wrong. Right?
Why are you in business? Yeah.
Exactly. And why do you have this rental property if you're going to lose money and write off against your own personal taxes?
Nobody likes losing money. Everybody's in the business to make money.
Yeah, but they like to write it off.
I know. So basically, if you're going to buy a cottage, well, right now, timing to buy a cottage, fantastic. You can negotiate huge deals there. Yeah. So you go up there and just hammer away. And but how do you figure out, like, if everybody's overpriced and nothing's selling, how do you figure value? You know what I mean? Like it's like, what is the real value of these cottages? Because everybody's overpriced. Like, do you just like let's say a buyer comes in, and like a guy from Toronto, an agent from Toronto brings his client to Kawarthas, and there's $1 million cottage for sale there, but really it's maybe worth $600,000. He submits an offer of $750,000, so he's still overpaid on an overpaid listing. You know what I mean? Yeah.
Well, the volatility up there, there's a lot of volatility because, well, think about how they skyrocketed during COVID. There's only a finite amount of waterfront properties, and that's why they had to go to these other kind of secondary cottage areas. So it's the same thing. The volatility, they'll drop. It'll be significant. It won't be like 5%. It'll be 10, 15. The volatility. If you did a graph of cottage properties, you'd see a bigger, not a stable line. Absolutely not.
So you were that article that I got this from, was it the Globe? What was it? The Globe and Mail that I was reading?
Yeah. Conrad, Financial Post. Yeah.
The Financial Post. Now, you wanted to talk a little bit about Lake Erie cottages, and one just sold with your brokerage there for what, $4.5 million?
More than about 4.8. Yeah, absolutely, almost 5 million. Yeah.
Wow. Mm-hmm. Tomorrow will be 6 million. No.
Yeah. Well, it's interesting though. Some of those secondary markets are faring well because, again, the travel. Unless you're uber wealthy, and I know of people that they do a private plane to their cottage, and if it wasn't for that, they'd probably sell it, even though they love their cottage. Yeah. Just the time is a problem, right?
Oh, yeah. I know. It's brutal. Now, I would rather buy a cottage in Lake Erie, which is probably an hour an hour and a half, not even an hour and a half drive. You get yourself.
Yeah.
Price point is good. I know Lake Erie is shallow and everything else like that. I know it's not like the lakes up north, but I'm telling you, like if you can get to a cottage in an hour, I think you would utilize it more. 2 hours, 3 hours. I got a friend that's got a cottage 4 hours away. Forget it. Are you kidding me? Like that's a long time. I couldn't do that.
It's a commitment. It's gas, it's groceries. It's like, it's a whole day to get there.
Oh my God. Yeah. Like it's like you can't even go for a weekend. Like you gotta extend your weekend on a 4 hour trip if you do that every other weekend or every weekend. But I personally think, I would go to Lake Erie. I know there's not. I think that is the way to go. I know that the lake is a little bit more wavier than it is up north, but I don't know. For me to drive 2, 3, 4 hours for a cottage is not my cup of tea. How far do you have to drive, Brian?
3 hours. Yeah, and that's quite a bit. Like 3 hours, is a lot.
Yeah,
you know?
Yeah, it is. It is. So hey guys, listen. I want to talk about this. So I came up with thing now. Now I sent this to you guys. Am I right on this number? Am I right with the real estate versus mutual funds or stocks?
Yeah,
Right?
it's pretty. Yeah. And I'm glad you did this because there's so much noise around this now. You have no idea, and there's lots of holes in the arguments that people are making. So I'm glad you said this. Yes, go ahead.
I'm gonna give you the scenario. Okay, based on an $800,000 per investment property, $800,000. Okay, let's say you buy a duplex for $800,000. Okay, down payment you have to put 20%, right, Brian? Yep. Okay, that's $160,000 down payment. Land transfer tax and legal fees is going to work out to about $14,500. That's pretty accurate, right? Okay, so your total investment in buying this $800,000 property is $175,000. Okay, now you own the property, the $800,000 property. The appreciation in 1 year, let's say 6%. It's pretty high, but I'm comparing apples to apples here. 6%. You made $48,000. Your net worth just gained $48,000. Okay. Now, the second year, let's say it gains another 6%. Now you gained another $50,880. So you're almost at $900,000 value of this property, which you almost gained $100,000. Almost $100,000 in net worth you gained owning this property.
And there's something else on that, Rob, too, just to jump in. You didn't account for the principal pay down. If you've got a mortgage on a rental property,
that's right.
You're down $8,000 to $10,000 on a mortgage there, so that's another $20,000 a year to add on for principal pay down.
And okay, so that's that. So you've made net worth close to $100,000 there. So now stocks and mutual funds, your same investment, $175,000. Okay, appreciation in 1 year, let's say 6%, the same number. You made $10,500. Big deal. Okay. Second year, now the stock value is worth $185,000, 6%, another $11,130. So now you've made maybe what, $20,000 or $20,000. Plus you got to pay fees every year on this.
Oh yeah. Yes.
You got to pay fees. Even if you lose money or make money, you're paying regardless. So I just don't get it. Like hire a property management company to manage the properties. Guys, what most millionaires come from real estate owning real estate.
And you know what, too? There's so many derivatives of this equation. And every single one comes up with real estate, because another thing, too, if anybody says, oh, that's too high of a return, who gives a shit? I'll take 2% increase on real estate, and I'll take a 15% return on my investment. I'll still come out ahead. And the other thing, too, is you're taxed way worse on the investment. You can be taxed on interest or dividend income. Even if, and to those first-time home buyers out there, even if you're buying your primary residence, guess what? And even if you sell it after 5 years and you pay a real estate fee, capital gains are tax-free on this house. You know what I mean? So like this equation comes out 110% way better, no matter how you slice it, in my opinion.
Yeah,
So
but,
do you
but
think,
this
well,
was,
you think,
but Brian,
go
you
ahead,
got to
sorry.
correct yourself here. This was an investment property, so there is capital gains. It's not your
Oh,
personal.
yeah, but even
so
if
I
it's
don't
not,
want anybody
even
to think about that. Yeah,
no, but even if it's not an investment property and it's a
Yeah.
personal residence, it's
Absolutely.
capital gains free.
100%.
So do you think that after we publish this podcast that we'll get some comments from?
for sure. Yeah. Well, you know what? Back in May, I did it. I did it back in May, and I compared the TSX composite, and I also did the S&P composite.
Yeah.
And it's very erratic, where home prices are more stable.
Yeah.
And the fees, people don't realize. And now what's happening is U.S. is talking about private assets, that people allowed to use their 401k or their RSP and use private assets. The volatility on private assets and the fees on that is outrageous. So everybody looks at this big return, but what is your net gain at the end of the day? And that's the piece that's the most important.
And I'm going to add one last thing too, because I love this thing, is human behavior. Listen, when you come across shitty times in your life, you take money out of your savings or investment. And God knows when people blow this out 5 or 10 years, if you need money, it's coming out of your investment. But people do not take money out of their house as often as they will out of their savings.
That's right. That's right. And then that's right. And then after
Oh.
the hard times, they realize, wow, I'm glad I kept my house. My house is starting to climb up in value. Yeah.
Because it's hard. It's hard to dispose of. It's hard to dispose of. It's like they're all saying, well, the other one's easier to dispose of, and you can find it. No, the beauty of it is more difficult to dispose of, and it's almost forced savings. And the other thing is it's exponential. The 5%. The difference between is your 5% is on your 160 grand. The 5% is on the 800,000.
That's
the
right.
Other piece. It's this exponential investment.
Yeah.
Even if, I will do it at 3.5, at 3% all day long, and I'll get the same number.
Yeah, you got it. That's guys. That is freaking great. Anyway,
on this, Rob, we can bring on the comments for it. Bring on the comments.
Yeah,
I can't wait. I want to see the comments on this. Come on, I challenge anybody to challenge this. You got it. Anyway, guys, thanks a lot. We'll see you next week. Great segment, and have a great weekend.